SunTrust and BB&T received approval from regulators to form America's sixth largest commercial bank. This is the biggest bank merger since 2008's financial crisis, and the combined company will serve 10 million consumer households with $330 billion in deposits. BB&T, ticker BBT, and SunTrust, ticker STI, will phase out their brands over the next 2 years as the combined entity will be known as Truist. Once the deal closes, Truist will begin trading on the NYSE under ticker TFC. The merger faced criticism from Senator Elizabeth Warren and Maxine Waters, who have been supporting for the breakup of big banks and big tech. However, voted in favor of the merger, citing that recent regulations have reduced the risk of a mega bank failure of the likes of Citibank and IndyMac in '08. So it seems like the consolidation and mergers are the state of play these days, with companies getting hitched left and right in order to cut hefty capex costs, exploit synergies, and process optimizations. Companies are doing all they can to drive efficiencies now in the face of a slowing economy and the trade war headwinds. So to catch us up on the latest, we bring in TJ Watkins, Director of Stocks at Simpler Trading. So we all remember what happened in '08 when giants like Citigroup, they were required an epic bailout to save them. So with the creation of this giant, are there concerns of a potential risk to financial stability? And in the event of a failure, who would be big enough to acquire them?
Well, what I really pay attention to is we say that history doesn't repeat itself, but it sure rhymes. And so something like this, if there is going to be a problem in the future, it's not going to be like 2008 where it was the financial mortgage subprime housing loan issue. It's going to be something different. That's what we're going to have to pay attention to. We don't know where it's going to be if there's going to be something like that. As far as with this merger, we hope that it's going to be good for everyone involved, to expand the community, to bring better services to them. And really, if we start seeing them fail, I don't think the question should be, who's big enough to acquire them or bail them out. I think as a free market country, we should be saying, hey, if they ran their business poorly and it got to this point to where they can't sustain it, or they read the current wrong, or they just aren't doing it right, then we let the free market do what it does. And if they fail, sell them off like a yard sale and pick up the pieces. And usually when that happens, they come back stronger and better.
Yeah, no more of this too big to fail stuff. If you fail, then that's on you. Also, speaking of monster consolidations here and mergers, Charles Schwab in talks to buy TD Ameritrade for a total of $5 trillion. That's trillion with a T in combined assets.
Yeah.
This is in the face of the mounting threat on two fronts, really, right? Blockchain and cryptocurrencies, and disruptors such as Robinhood, Betterment, and Wealthfront, they all have zero commissions. So give us your take on this $25 billion deal, and do you think that any of the other guys in this space are also looking to kind of merge and create these monster companies?
Well, kind of like we were talking about earlier, with the streamlining and trying to make bigger efficiencies through bigger companies, I wouldn't be surprised if we see some other mergers, especially coming from those disruptors. Maybe some of the bigger names actually want to bring those disruptors on and say, hey, let's bring your new age, your new territory of people and subscribers on board. And personally, as me as a trader, I really like TD Ameritrade. I like their trading platform. And to have them come together with Charles Schwab, it sounds actually like a pretty good situation, And what we're looking at, when I called Charles Schwab after they announced this, I called and spoke to one of their representatives, and they said, we really don't make a lot of our money from commissions. And so they said, if we're having troubles, if our bottom line isn't doing very well from a lack of commissions, we're doing something wrong. And so not having any commissions in this race to the bottom, as everybody's talking about, I don't think it's really that big of a deal. Their money is made elsewhere. And really, how many people does this affect? It affects us as traders, but I think to the standard, most people, it's $4 or $5 that they don't have to pay now every once in a while.
And real quick, if they're not making the money on commissions, where are they making it from?
Well, they have a whole lot of other fees. They have management fees. They have assets under management. And then similar to how a bank, how they take your money and they actually loan it out, and then they make money off of your money that's sitting in the bank. That's how Robinhood, that's how Betterment, that's how Charles Schwab, they make money from your money on deposit. There's something similar to Venmo. We have our banking and our transactions that are for free. Well, it's because any money that we have on deposit there, they're using elsewhere to make interest off of, and so they give us the benefit of having transactions for free.
All that works well and great when you're in a bull market, but come one failure, come one default, and they're in serious trouble. Now, Over in retail, another struggling sector, LVMH is still pursuing to close Tiffany's, and it's raised its bid now to $16 billion from its earlier bid at $14.5 billion. So Tiffany plans to continue to negotiate for a better offer, arguing that it is still being undervalued. The current offer now raises the price tag to $130 per share. So where do you think this would end up? And what's your baseline of a fair value, given that Tiffany's is a classic brand equity and you have tremendous name recognition there?
Well, coming from just the charts and the stock, looking at that, Tiffany would be well poised to actually take that offer. Louis Vuitton stock has been doing great for a long time, and Tiffany has had a high of $140, and with this offer, it now brings it up to $130. So, you know, just looking from that with the numbers, it seems to make sense. And I don't know how much higher they could go as far as the offer. Now, what it comes down to, I think, is more of the intangible, where we're looking at what is the name recognition of Tiffany. It's been around for a long time. It's a solid name. A lot of people know of it. It has a good reputation. And I think it comes down to, is Louis Vuitton, do they really want that name? And do they want that kind of clientele that comes with it? And they might just have to pay more to have that kind of name recognition for such a long time and bring it on board. And that way the two of them actually maybe are better together in the big picture in the long run.
And then finally, we have this other dying segment that we got to talk about here, printing and paper business. Hewlett-Packard just rejected Xerox's offer, saying that it undervalued the business and that given the weak balance sheet of Xerox, potential synergies will be difficult to extract. HP is already in the middle of a massive restructuring, and, well, let's face it, they're struggling to stay relevant here. So will the combination, do you think, of two failing businesses result in a win, or one now bigger failing business?
Yeah, it's kind of funny how you look at that. And this one's interesting. When I was looking at it, you know, Xerox's market cap is about 1/3 of HP's. So in a way, this looks like it's David trying to buy out Goliath. And not only that, David is looking pretty aggressive like that. There's been talks of hostile takeovers, you know, buying him out through just purchasing up all the stock and shares. And so this is kind of an interesting thing. As you said, kind of two old businesses that are trying to stay relevant are duking it out with each other. You know, HP is really trying to revamp itself. It is trying to restructure. They are trying to cut costs, and they're in the middle of this process for that. And I think that maybe coming from their side of the table, they're thinking, hey, we're trying to figure this out. You know, we want to go through this first, and how dare you come in here and try and take us over when we're in the middle of trying to, you know, better ourselves. And so it's a little bit confusing. It should be interesting to watch as these kind of fireworks happen between the two companies.
Yeah, it's kind of like watching a slow-motion dinosaur fight. TJ Watkins, Director of Stocks over at Simpler Trading. Thanks so much.
Great, thank you.